Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. CPI is about 26 minutes away. That inflation print coming as the FOMC's two-day meeting comes to a close, likely determining what the dot plot looks like going forward. The former St. Louis Fed President, Jim Bullard, saying he only sees one or two cuts on the table this year thanks to slow progress on inflation. Jim is with us here in New York. Jim, good morning to you.
Good morning. Good morning.
Just fantastic to see you, sir. I want to talk about your dot plot from a long time ago. We all remember when it came out years ago, and you said enough of this. You put your dot right at the bottom and left it there for the next couple of years. How do you approach the dot plot, and how do you think these officials would approach it today?
Yeah, I mean, at that time, I wanted to get the idea across that we had just switched to a low interest rate, low inflation regime, and that we were unlikely to break out of that regime anytime soon. And so it was probably a better forecast just to say that you're going to stay in the regime. Now that the pandemic came along and upended the global macroeconomy, it looks like we're in a different regime now. So maybe it would be a different dot today.
Well, let's play it. Do you think it would be post-GFC in reverse? Would you just leave it up there at 550 for a couple of years out?
I think that's a little high. I'd like to see the yield curve normalize here as the final piece of the soft landing. But I do think yields will be higher going forward than anything we saw between 2009 and 2019.
Do you think that the Fed is accurately reflecting that in their current projections?
That rates will be higher for longer? They've got their long-run dot at 2.6. Maybe that'll shift up a little today. I think the idea that you're going to have that low of a policy rate, I don't know, that's getting a harder story to tell, I think.
Well, so Steve Raschuto was on earlier, and he said essentially there's a real test of the Fed's credibility right now at a time where some people are saying that we're essentially going to vacillate between 2 and 3% in terms of inflation, or even stay at 3% given the Fed's proclivity to cut rates in the near term. Do you agree with that? That essentially this is a 3% inflation target that just hasn't been enunciated by the Fed?
No, the target is 2%, and if inflation stays above 2%, then policy has to be at least mildly restrictive to try to push inflation back to 2% over a reasonable time horizon. But a key thing is what time horizon do you think it should take to get inflation back to target? And if you look at these projections, they're probably talking 2 years or something like that. So you got 80 basis points to go on core PC inflation. You can do 40 basis points in 1 year, 40 basis points in next year. And so it's not the urgency that we had when inflation was much higher just 2 years ago.
Jim, when you're putting together these forecasts, how much collaboration is there on the FOMC? Do you all go off into a corner and just sort of plot it down? Do you do it ahead of time?
That's pretty much what it is. I have actually tried to call around to my colleagues and stuff, but it's very time-consuming to call everybody, and they've got their own staffs and their own stories to tell, so it works better just to give your own view. And so there's a lot of communication by osmosis, too. You kind of know what everybody's saying because you see them all the time and you hear their speeches and everything.
Because we heard from someone yesterday that kind of basically said that for the Federal Reserve it would be better if the implied cuts this year, the median dot for 24, came down from 3 to 2 and not down to 1. And Lisa and I were basically saying to that individual, well, what are you talking about? You're telling me that Chairman Powell's going to get on the phone and say, look, guys, we need to massage this and collaborate and make sure the median dot just shows 2 cuts for this year and not 1. That's not how it works, is it?
No, and people have strong views, so I don't think, they take their role very seriously on the committee, and they're not really willing to say, I'm going to compromise my view just because of, something that might happen on that particular day.
Yeah, but this does raise this question of how do you message it perfectly? Is there true consensus? And what's the differential between consensus view and I dare say groupthink or something where people all sort of are coalescing around this idea that inflation is maybe a little bit higher, but not that much higher, that rates are restrictive, even though the economy keeps chugging along?
Yeah, I think one thing to keep in mind about this is that the board staff serves the whole Board of Governors, so they kind of have they all see the same analysis and the same, have the same projection, and then they may have a view relative to what the staff presents, and then they might deviate a little bit, but they don't have their own independent staff, whereas at the banks, all the banks have their own research teams, and they might have very different views from what the board staff thinks. So, you know, the tendency for some of the dots to be clustered would be at the Board of Governors. You
were on the Fed in 2020 when you were dealing with some of these issues, and that was the last time that we had a CPI print the same day as a Fed decision.
Yeah, it's like a solar eclipse or something.
Yeah, this is so we're staring into the sun, the political sun, and it's a solar eclipse. You're here for us. How much does it really alter the discussion?
Yeah, I think I would just caution viewers here and listeners that what happens is on this day of the meeting, this meeting will start at 9 o'clock this morning, the first thing that will happen is that the staff will come out and say, here's what the CPI report said. And most people will know the number, at least the headline number at that point, but they'll give a brief analysis of that. But the only thing that will matter is it different from what the staff forecast? So did it come in hotter or colder than the staff forecast? If it came in about as expected, then the staff will say, well, this didn't change anything because we already expected this. So usually it's not big news at the committee. It would have to be some blowout difference.
Do you think that it is correct that the balance of risks between inflation and a slowdown in growth is roughly balanced? Or do you think that it's more heavily weighted to one than the other?
Well, inflation's been high, and I think we want to finish the job here and get inflation back to target. So I think that's still job one. And labor market seems pretty strong based on the jobs report, last Friday, and other aspects of the economy seem pretty good. Atlanta Fed GDP now for the second quarter up over 3% at an annual rate. So
changes daily.
It does, but I think if you're just tracking and just trying to make a statement based on the data that you have in hand right now, growth looks pretty good, labor market looks pretty good, inflation's still too high, might as well stay a little bit hawkish.
Jim, I've never seen people so sceptical of a 272 on payrolls as they were on Friday. Can you walk me through how you interpreted that economic data, both on the establishment survey and a household survey, and how you'd read into that? Because when you say maybe we need to be hawkish today, some people think based on that number Friday we should be dovish. I mean, how would you interpret that economic data?
Yeah, unemployment ticked up to 4%, and that's interesting, but it's still below pretty much everyone's estimate of the natural rate of unemployment. So they've been saying that, we've been saying at the Fed that unemployment should probably be expected to run a little bit higher than it has, and low fours or mid fours on the unemployment rate is a very good number still for the U.S. So, and then on the headline number, I was just thinking about this, so I plotted something that no one ever plots, which is the percent change year over year in non-farm payrolls. So if you look at that, a year ago you would have been at 2.5% growth year over year. Now you're at 1 3/4 year over year. So that does show the slowdown, but the 1 3/4 would still be faster than. So if you took that to be the run rate, we always go on the monthly number, which is so volatile, and how are we supposed to interpret this about other measures of the economy? You will go on the year-over-year rate, and that controls a little better for seasonality and stuff like that.
Francis Donald of Manulife alongside us as well. Francis, I want to get out to you and get your early reaction to that CPI print.
I literally breathed a sigh of relief for a lot of reasons. I suspect Chair Powell did too, for consumers who are not going to see as much month over month increase in prices. For all the economists out there with a September rate cut in their forecast, they're probably also relieved. But also bigger picture, higher rates are working to bring down inflation. This was an increasing concern. Are rates restrictive enough? Do we keep them this high? Why is inflation not moving downward? That said, John, this is one print. We have 3 more before the September meeting. And as exciting as this is this morning for a few hours, I'm more interested on the CPI print that comes out September 11th, just 1 week before the Fed's September cut. That number may end up being much more important than this one. So we'll take it as a win. It's good news for consumers, for markets, for all, but it's one print. And we got a lot of information coming through today.
Francis, Jim Bullard was also talking about the pain speech in Jackson Hole that Jay Powell gave a couple years ago when he said that essentially this is inflation that's running too hot and we are going to get inflation back down and it is going to require pain in the economy. Francis, you are expecting to see that pain. We haven't seen it on a broad-based level. Do you have a sense of whether this disinflation is the immaculate type that we've been talking about, or whether this is just one dot in a series where things are kind of shifting? We're at a tipping point.
I would hope that would be the outcome for the American people. At the same time, our leading economic indicators on the jobs front continue to show weakness ahead. We're at a 4% unemployment rate. I'm watching today to see from the Federal Reserve, they already had 4% penciled in for the end of this year. Are we really going to go through the next 6 months without an additional tick up in the unemployment rate? And let's remember, the simple rule of thumb is that it takes about 2 years for those rate hikes to work their way through the system. And we're 2 years and some change after that first rate hike. We're not at the end of the impact of rate hikes. We're at the very beginning. So while magnitude of the downside for the U.S. economy is up for debate, the direction shouldn't be. There probably will be a much larger slowdown in jobs in the second half of the year. And this is when the Federal Reserve will have sufficient data to begin cutting interest rates and bringing those rates down, beginning, we think, in September.
Jim, what's your take on that, given the fact that it seems like something that feels like a stretch for the unemployment rate to stay where it is for the foreseeable future?
I think it is immaculate disinflation. And again, I think that, by being credible and moving quickly, the Fed was able to get firms to change their pricing strategies quickly. The inflation came down relatively quickly. And so, one simple theory about how this works would be that the Fed threatens recession. Everyone looks ahead. They see that might be a possibility. They don't want to raise prices into that. And the inflation goes away relatively quickly. So that isn't the most popular theory around here or on Wall Street, but that is, that is something that you have to take into account because the anticipated effects can overwhelm sort of the mechanical effects, and you get lower inflation right away. So this is something I was advocating for in 2022, that we, let's move quickly. Let's try to quash the inflation quickly. And this report today is helping that story.
Forgive me for going off piece, but just entertain me for a moment. French 10-year. Yields down by about 7 or 8 basis points right now. That CPI print was more important to the European bond market than anything Macron's had to say in the last 12 hours.
The banker to the world, the reason why Jay Powell should go on tour, but ultimately it does highlight how this is the market that everyone is watching regardless of some of the external factors.
Ira Jersey of Bloomberg Intelligence joins us now for a little bit on this bond market. Ira, the most important data point in global finance. Your thoughts on this one?
Yeah, obviously better than some people had feared. It was on the core CPI, it was a low 0.2, so it was actually under 0.2%. And I think that's something that traders have been able to kind of grasp onto. And like you noted, this is pulling down, all global sovereign bonds at the moment, bond yields at the moment. So you look at German yields are down by 6 basis points, like you said, France down by 7 basis points, but remember the beta to that is only half of what's going on here in the U.S., where you have 5-year yields off 15 basis points at one point. And that just shows that, we're now going to be pricing in for 2 full cuts probably before the end of the year. And then as you get additional data, obviously the market's going to have to shift those expectations pretty dramatically.
So, Ira, I have a question for you. So if you just took rebased where inflation is now and you said 0.2 every report through the end of the year, you would get year-over-year core PC inflation on a 12-month basis at 2.8 at the end of the year. So we started out at 2.8 in January on that metric. We'd end up at 2.8. So maybe that's not really enough. You need even better reports in order to be able to show progress through this year. What do you think of that?
I think part of it, James, is the fact that we're not increasing, right? So a couple of months ago, when we had a couple of inflation scares, the market really dragged onto that and said, okay, what happens if the Federal Reserve doesn't cut at all this year, or maybe even hikes? Because keep in mind, in January, the market was pricing for almost no chance of the Fed staying on hold this year, and now we're actually pricing, or were pricing, I don't know where we are at the second, but we were actually pricing via options on short-term interest rate futures for about a 20% chance of potential hikes by the end of the year. I suspect that if you get another print similar to this, where you have another, call it 0.2 again on the core, that people will say, like, hey, progress is being made. The Federal Reserve is still more likely to remain on hold and or cut than they are to be even thinking about hiking interest rates before June 2025 at this point. So I do think that there is a sea change, and it matters. And to your point, like, I still think that the market is going to say, okay, what's the trend versus where we were, as opposed to just looking at, okay, 0.2 forever is probably not going to be sustained.
Ira Jersey of Bloomberg Intelligence. Ira, thanks for that. Appreciate it. If you are just joining us about 14 minutes ago, we got this data: 0.0% month-over-month headline inflation against an estimate of 0.1, previous number 0.3. Stripping out food and energy, Bramo, 0.2% was the number, 0.3 was the estimate.
And Jim Bullard, former St. Louis Fed president, just moments ago saying that this is the immaculate disinflation that many people were looking for. Francis Donald's still with us, and Francis, I'd love your take on that. Do you see this as the immaculate disinflation? Can you bet on that and arrange a portfolio around it?
Well, for June, it feels like immaculate disinflation, or for May, we had this really large decline or no change in inflation month over month and a pretty good non-farm payrolls number. That's exactly what this immaculate disinflation would be defined as. So now it's about what do we see next. And on this front, I do see some downward momentum that is occurring in the economy. But let's remember, if you're sitting on a trading floor, you're managing portfolios, numbers like this aren't just about changing your base case. It's not that something like this would make you move from a December to November or even to a September rate cut. It can often be about reducing the balance of risks or the tails of the risks to your base case. So this number probably isn't going to change anyone's outlook as to what will happen next. That'll be based on their forecast. But it does reduce the chance that the Fed would, if you had it in your scenarios, have to hike again, or that they have to stay for a prolonged hold. So sometimes it's about reducing those fat tails on your outlook as opposed to the individual. That is tradable, but usually around the conviction of your trade or the balance of risks or how much leverage you're putting onto it as opposed to the trade itself.
What could Jay Powell say today, Francis, that would really move the needle in your book?
Well, he could speak to some of his longer-term concerns that aren't inflation or jobs. For example, well, he can't do it, but interest costs for the federal government are very high. They're about 19% of revenue is going towards interest costs. If he were to talk about, and he probably wouldn't, some of the risks of higher for longer, that would move the dial. But we have 3 more inflation reports, 3 more of just about everything until we get to September. The Fed is in a holding period. The market is in a holding period. And each individual data point, each individual Fed commentary will be far less important than the sum of all of their parts. So as much as this meeting will get a lot of attention, I'm sure we'll talk about it all day, I'm far more interested about the evolution over the next 3 months. That will be more important than any singular event.
Francis, one of the best. Thanks for being with us. Francis Donald there of Manulife. Citi's Scott Chronert writing this. The market appears to be pricing a first Fed cut in December. Citi's economists have confidence in a September cut, predicated on decelerating macros. All told, the S&P 500 continues to be influenced by the structural growth opportunity in generative AI as an offset to the mixed macro picture. Scott's with us now for more. Scott, I'm going to say it for you because you won't do single names on TV. But is this just another way of saying ignore the Fed and buy NVIDIA?
I think it's another way of saying that Wall Street's much different than Main Street, and the Fed's influence is mainly a Main Street issue in terms of the economic activity that underscores, U.S. equity fundamentals.
We've heard it a million times that the equity market is not the economy. Is this S&P 500 in its current form a pretty good example of that?
So we've done some what we call sanity check work on this, and if earnings solely follow GDP over time, our back of the envelope is that the S&P would be worth 4,600, okay? So what you're paying in current levels, 53 and above, is going to tell you at some level what you're paying for the expectation for growth over and above economic activity. And clearly this is being influenced by the mega cap component and the AI tailwind that it now has. What it basically says is that for those that think, my gosh, we're in an equity market bubble, I'd say, well, your downside is probably 15% in that regard. And when you step back and look at it with the new growth driver that we do have regarding spending on AI and other metrics around that, the S&P is actually in a pretty good fundamental place.
We've been joking, Scott, that the best bet right now, or the bet that everybody comes on and says, is they're having cashed NVIDIA, and that's essentially the barbell approach that they've been taking, or basically tech and big tech stocks that are generating a lot of cash, and then cash itself. And that's the approach to take in a macroeconomic environment that is highly uncertain. How concerned are you about this type of behavior leading to real crowding in a specific number of stocks?
You know, Lisa, I think it's a really good point. We're obviously very concerned about crowding, but what I would say so far is that you look at valuations, got it, but when you look at PEG ratios, which is your PE over growth, it turns out that your PEG ratios have actually come down. So what's been happening is that the underlying earnings expectations for these mega cap growers have actually been supporting the price action and the valuations. Now, to your earlier point, though, whether you want to call it a joke, but I think it's reality, is that you're right. What you have is a Fed policy circumstance that is at risk of unintended consequences. So on Main Street, if you're a non-saver, you've got issues. You've got higher inflation that presumably is coming down now, and now higher interest rates. That's a much different setup than if you're a saver and you're now earning a decent return on your cash, which is much different than prior to COVID. It's the same thing in corporate America. So the mega cap growth tech part of the market does tend to carry lower debt, more cash. That's a market different discussion from looking at sectors like commercial real estate or real estate and utilities, staples, parts of industrials, where they do tend to be more debt laden. So the fact here is that the Fed, whether it's intended or not, is providing a different type of headwind and tailwind to different parts of the economy and different parts of the stock market.
If the Fed were to start cutting rates, would that make you more constructive on these other areas, or would it kind of depend?
It kind of depends. So the other work that we've done recently basically says if you were to cut 200 basis points of Fed rates over the next year, that would create, all things equal, a roughly 1.7% earnings drag on the S&P 500. Essentially, those mega cap growth companies would lose would lose more in their cash income than they would in what they pay on their debt. So, it's a bit of a circuitous argument on this, but as you go down cap, as you go down into small mid cap, this is where now you begin to trade more aligned with the underlying economy. You don't have that mega cap influence in small mid almost by definition or implication. You've got a lesser tech weight. You've got higher industrials exposure. You're more economically sensitive. At the margin, small mid cap would benefit from a rate shift. But the perspective here is that historically, when we've gone into more prolonged periods of Fed ease, it's usually been on the other side of recession. And during those recessions, you tend to have a major drawdown in earnings. We don't think we're looking at that right now. So it is a more mixed picture this time, Lisa.
Scott, before you go, I just wanted to mention the Pulse Monitor that you and the team put out and pick out the S. An opportunity, of course, to talk about the late, great Tobias Lefkovich as well. Can you talk to us about where sentiment is right now, Scott? Because it feels like on this program, 1 minute everyone's bearish, the next minute they're super bullish, and it changes day to day.
Yeah.
Where are we?
Well, our sentiment read, we're in euphoria. We've been there for a couple of weeks now. We've been in and out, right? So we went clearly into euphoria at the end of Q1. We had that April pullback, pulled us back out of euphoria. Now we're back in. The way we're spinning it around, John, is that we're focused a bit more on your cross-asset valuation work, which off of this recent rally, what it has done is begun to switch the cross-asset valuation a little bit more in favor of bonds. And so the combination of that, where we're trading versus our estimates of fair value for the S&P and the Lefkovich index, all suggest to us that we're looking at a market that's due for a bit of a digestion in here, but that's a different discussion than the longer-term fundamental setup, which we still think looks pretty good.
Scott, you're one of the best. Appreciate your time this morning. Thank you, sir. Scott Chronert there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.